Alrighty, let's get into more Nike.
The quarter, but no one was looking at the quarter. No one was looking at the next quarter. We're probably looking at the second half of 26, and maybe this gets pushed out to 27. So what I like is what the ladies are talking about on inventory. Essentially, you've cleared out inventory, and I think they were, inventories were down somewhere going into this number around 11%. They're probably going to show down even more so. So finish with $7.5 billion. Also, some sense that the previous management team was really giving ground on wholesale, and that in fact you'd seen full price selling something that was a problem, and that this is really where the company is going back. This is where I think the market, the investor community gets more excited about it. In terms of product and innovation and the things that I don't really have a great call on this. I do think you have a case here where the stock as an investment is something that you can own now. I think you've de-risked it. I think you've taken a lot out, and you haven't necessarily bought into Elliott Hill as a white knight, much in the way of some other companies that have changed CEOs. He had that first reaction. At 27, you could see an EPS inflection of this company north of 40%. I think you can own it here.
Is the 800-pound gorilla in the room that Elliott Hill has been there for 40 years, and he's the turnaround story? Where's the innovation going to come from? And I'm not being real.
Okay. So first off, Elliott Hill hasn't been at the company for several years. He just got brought back in, right? Board of directors made a bad mistake. They brought in, Mr. Consultant, and he ran the company into the ground for a few years, right? Elliott Hill has an incredible track record at Nike, and I wish this gentleman, Steve Grasso here, I wish he would do a little more research, because you got to understand, Elliott Hill has had an incredible career at Nike. He's a big part of why Nike became a giant. He got passed over for the CEO role several years ago, right, many years ago, and he left the company, and they brought him back in. And from everything we hear, the workforce loves him, they're engaged, and they're ready to rock and roll and dominate over this next 5-10 years. And so, this whole thing about, in innovation, everybody gets so caught up in this innovation. Nike's got to innovate. Dude, they sell clothing and shoes. They don't need it. Super innovate. Run the brand great. Run the company great, right? Have great distribution with your partners, all the companies, DKS Sporting Goods and Foot Locker and all the other million stores, right? Which is something that Mr. Consultant, the previous CEO, ran into the ground. He burned a lot of bridges there, and Nike's building them back, and Elliott Hill's building them back, and it's going to, in my opinion, do phenomenal things over the next few years, right? Build back relationships in China for their China business, right? And in Europe as well. And so, people act like this is a tech company, like this is Apple, and they got to have some super innovative, new product come out. No, they just got to run the business really well. And the last guy was not running the business well. Run the business great, have the brand be great, and people will gladly go buy Nike shoes and gladly go buy Nike clothes. It's not like rocket science in regards to this one.
Aggressive towards
people always got to make it like way more complicated. This is not complicated. The old guy was not doing a good job running the business. I told you guys this was a big mistake years ago if you used to watch my channel back then, right? I called this out. I said, them trying to break up with all these guys, it's going to come back to bite them. Nike back then, with that old CEO, Mr. Consultant, wanted to go, direct to consumer, huge mistake. I'm like, no, you got to understand, you're going to lose shelf space to these other competitors, right? They're going to build bigger brands because of that. No, you can't. You got to have a strong digital business, but you've got to have great relationships with all these mall-based retailers as well. You don't have great relationships with those guys, what have you got then? Yeah, that's so vital to Nike's success long term, and Elliott Hill's building back all that, and we're going to see that in the numbers over the next several years.
Or maybe I am, but where is that innovation going to come from if he's been there for 40 years? Did he have it already?
So for you, it's really a wait and see.
36
stock is
right, exactly. It's only recent.
Fair point.
And he's not the only guy tasked with innovation. He's the CEO. But he's not necessarily.
Yeah, exactly. That's so silly. Do you think Elliott Hill's going to be back there, designing a new Nike shoe? What are we talking about here? Come on, man.
The guy that's probably on the front line of product innovation, if I had to guess at this point.
I would say that when you look at a CEO, it's the guy that you're playing a round of golf with, right? That gives the 50,000-foot up story. This stock has been in a declining trend line since November of 2021. There's more than the problem is. It's the private companies that are taking away from share. So what exactly are they focused on? Shoes, apparel, digital? If they're trying to get away from Air Force One or Jordans are 15% of revenue. Air Force One is 1% of revenue. They're trying to build up women's apparel. So if women's apparel is 3% of overall revenue, are you going to go and buy at Nike now?
I always did, so I did.
Would you increase?
I mean, if they had the right product lineup, I don't think share is just taken away. I mean, I can't believe you said that yourself. It was a setup for Guy to say that Tim would buy women's apparel, but for you to say that you would.
Whatever.
Oh, Tim, I don't know.
Wrong person, wrong time. They need a new blood, and I agree with Tim. He's not the only one tasked with it.
So no matter what, you're not buying into Elliott Hill.
No, I think you're going to get a pop, but I think tomorrow the stock is going to be down roughly 3 to 5%. This is a
good call. It's probably a good call in regards to that. He might end up being right, but I mean, so his take on the short-term stock price move, I think, is very, very fair there. His take on the long-term, though, is just it sounds like he's not very educated on what's going on actually in regards to Nike.
Dead cat bounce. Yeah, Guy could talk about the technicals on it. It's below all its moving averages. This is a lackluster bounce of 2% where you should have had a rebound.
Yeah, I mean, Steve points out the level. Sarah said 50%. It's probably more like 65% from the all-time high a few years ago. Obviously not good. And as much as people want to say, it's a China story, China's the third region right now behind, obviously, North America and Europe and the Middle East. The problem is the deterioration in China is not turning around anytime soon. I think on the ground there's probably a big push to get away from Nike. So you got to feel that that's going to continue to deteriorate. The question is, can North America pick up the slack? Valuation has always been reasonable the last couple of years, but I don't know if it's about that right now. I think Steve is probably right in terms of innovation. Competition is there, and you have a series of lower lows and lower highs for a while. And I think this bounce is basically what we gave up during the day. I think it's short-lived.
It's not cheap either.
It's not
cheap at all.
Yeah.
It's expensive.
Yeah. Right. But as you and I were talking a little bit before the show, I always say, when you're a new CEO.
That's where you if you look at the PE ratio of Nike, sure, it looks not cheap, but you got to look at more of the forward P and the 2-year forward P, because what you're going to see after next quarter, essentially, is, in my opinion, a massive rebound in earnings per share, where when their revenues just start flatlining or even just slightly increasing, you're going to see an earnings per share that's up double-digit percent and likely up huge double-digit percent. And remember, these kitchen sink quarters they're reporting right now, they're going to get to comp against these next year. And do you know what the increases are going to be? And not only revenue, but that earnings per share number, the net income number. Oh my gosh. So you got to play this forward. You got to think about where we're at next year at this time rather than where we're at today.
The kitchen sink the quarter. And this quarter actually really wasn't bad, particularly North America. But what if this is the kitchen sink, right? What if this was a very conservative quarter where they could have done a lot more with the quarter? And so I don't know. I'm long, but that's not been the right place to be, but I'm staying long.
Yeah.
Yeah, I mean, this is the kitchen sink quarter. I don't know what else to say other than, yes, this is a kitchen sink quarter. All right, let's get into
Nike seems to be surpassing revenues better than expected, $11.3 billion. And that marks a decline of about 9%, but the street was looking for more like down 11%. So that was better. A big earnings beat, 54 cents per share, was much better than the estimate at 29 cents per share. Though margins were kind of soft to inline, 41.5 to 41.8%, which was the expected. Digging through some of the key markets here, North America, the home market, important, and also a beat at $4.8 billion. But China was a little bit soft, down 15% in China, in the greater China during the quarter. That is a disappointment. And I can tell you, after speaking to Matt Friend, the CFO, the China market is being reset. They are cleaning up inventory and making shelf space for some of the new styles. That's pretty much the story with Nike overall this quarter and where they are right now. The win now strategy, that's what the new CEO, Elliott Hill, is talking about. In my conversation with Friend, we are expecting guidance to come during the call, but it's only going to be fourth quarter guidance, not the full year guidance. And it will incorporate the new tariffs, the 20% increase of tariffs on Chinese goods. Remember, they make a lot of the sneakers and products in China. One sign I just want to share with you from the conversation, it's anecdotal, but I think it's important here because the numbers matter less in such a sort of dramatic turnaround. And that is the company is starting to see orders from wholesalers for performance categories and new sportswear almost fully offset the weaker sneaker declines in terms of these new orders. That is what they see as a leading indicator and some proof that they're seeing some early results, Morgan and John, when it comes to new products, some brand heat, some buzz. They had their first Super Bowl ad in decades, and the PEG Premium, for instance, has sold out. Starting to see some early results, and that might matter more to the street this quarter than usual.
Some great color. Sarah Eisen, thank you.
Thank you.
Shares of Nike up 4% right now. Well, joining us now with a reaction to those results is Oppenheimer's senior equity analyst.
Before we get into this analyst opinion, so how do I think this is going to play out? Let's call it next quarter, right? So 3 months from now, next time Nike reports. My opinion is they'll likely come in with beats on earnings again, likely beat revenue, likely beat earnings per share. And then they'll come out with likely their full year guidance. And my guess is full year guidance, assuming the economy doesn't massively deteriorate or something between now and then, right? It's just stays around the same. My opinion is they'll come in with a guidance that is somewhere around, growth of revenues of 3 to 7%, somewhere in there. They'll probably give a range. And so my guess is 3% on the low end, 7% on the high end, right? And then they'll probably, if they guide in EPS, they'll probably guide for strong double-digit EPS growth in the year or something like that, right? Because I think if they come in with those numbers, people will be like, okay, Nike's getting back to revenue growth. They're getting back to earnings per share growth, right? They're committing to that and strong earnings per share growth, right? And then, but they still would leave enough wiggle room that throughout the year they could come in and beat analyst expectations, beat them and beat them and beat them again, and you wouldn't set the bar too high. I think that's a perfect ideal situation. And then by that time, you can already be talking about Nike back $100 or so, right? So anyways, we'll see how it plays out. That's just kind of my opinion and perspective of trying to forecast this and see where this puck goes over this next bit of time.
Brian Nagel. Brian, what a difference 24 hours makes. It's great to have you back. We were just talking about this yesterday. So I'm going to start right there. Your takeaway from these results we just got.
Yeah, look, nice seeing you again. Look, I think Sarah said it very well. That the real key here is this was a low expectation quarter. So these numbers, while they're slightly better than maybe the street forecasts, but they're not reflective of a true healthy Nike. But again, they're against a low expectation backdrop. And really right now, we're seeing the stock here pop a bit after market. I think the key is, things did not get worse. And maybe we're starting to see some early signs of progress in this very significant turnaround that's happening in Nike.
Yeah, the commentary about new orders offsetting declines got my attention for sure. But the weakness that they consider to see in China and this idea of a quote-unquote reset, how important is that right now, especially in the context of trade dynamics and tariffs, which sound like they're going to start to get factored into guidance here?
Well, look, Nike in total, the whole company is a work in progress at this point, right? I mean, they've been resetting merchandising everywhere, including the United States. So when I heard, when Sarah said that for China, I mean, on the positive side, it tells me that, look, they're addressing issues in China as well. Now, China is very, very difficult to assess, especially for an analyst sitting here in the United States. What we've heard lately is, there's some pickup in China consumer demand. There's some stimulus effort on part of the government there. That's all positive. The negative, again, I think what you're alluding to, we just don't know. We have this trade war brewing, and that could very well at some juncture impact demand for U.S. goods in foreign countries like China. I don't think we've seen that yet, but that's definitely a risk out there.
Brian, it seems to me like if you're an investor, the important parts here are those wholesaler relationships mendable in the nearer term? And is Nike's innovation factory going to come back perhaps sooner than some might have expected? Are those the kinds of things that we really need to listen for to see if Nike management should start to lay out the benchmarks to measure their improvement and get that trust and valuation back?
No, John, that's exactly right. I mean, I'm going to say the same thing you said. I mean, the absolute two most important factors here are, one, product innovation. I mean, Nike's got to get back on its game in developing high-quality products that consumers want. And the second is, like you're saying, repair these wholesale relationships. I mean, Nike made a big mistake.
Listen. It is just so funny. Everybody sounds like it's so end of the world, in regards to this talk. The company just did $11 billion of revenue. The company just did, $794 million of net income. And this is, once again, all the talk is it's the end of the world, right? Oh, it's so bad. Oh, I got to do this. I got to do that. Oh, my gosh. And it's just Everybody else would switch places with that.
Chains,
Insane.
going too far into digital.
That's
but
speaks
again,
volumes
I
about the
met
company.
recently with the company's new CEO, L.A. Hill. He's all about this. These were his two big messages: bring product innovation back, reestablish relationships with key wholesale partners. I was on Academy Sports, a smaller sporting goods chain here in the United States. I was on their conference call earlier today. They're talking. What they're really excited about in their business is they're getting the Jordan brand and they're getting more Nike product here in the next several quarters. So there's a retailer, big retailer in the United States, very excited about what they're seeing from Nike. So, but I think that's exactly what has to happen here.
100%, man. Execute the business well, and Nike's set. Like, as long as they always keep the brand great, right? Make it desirable. Make it so, they're always got the best athletes and they're in the best leagues and all that stuff. Like, you can make this out to be a way harder, more complicated story than it's got to be, right? Now, if we can get some help with the consumer, right? If inflation can tame back down over the next few years, and the consumer in the United States, the consumer in Europe, and the consumer in China can get it to a little better spot over this next few years, that's going to help a company like Nike out as well, right? Remember, Nike is not one of those companies that sells to like just rich people, right? Nike is not a Wynn Resorts. Nike is not a Ferrari, right? They're not just a company that just sells to rich people and that's called a day. Nike's a company that sells to everybody. They sell the masses, right? A kid that gets his first job could go get himself a pair of Jordans, right? A parent buying their kids could buy him a pair of Nike running shoes, right? A guy makes $60,000 a year driving a trash truck could go buy some Air Force Ones that he really wants. Like Nike sells to everybody. And so if we can talk about the everyday man, the everyday woman being in a little better spot the next few years, that's going to do nothing but help out Nike in the end, right? If they aren't having to see their auto insurance go up 15%, right? And see their rent go up 10%. And all this stuff that they've had to deal with the past few years, if they can just not have to deal with that, that's going to help out all these companies that sell to the masses, right?
Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com.
Alrighty, so first up, a big buy here today was a Nike stock. That's a $20,000+ buy. And by the way, I was buying in my Patreon portfolio today. I was buying in the private group. The private stock groups. Obviously portfolio as well. So the public account, buying across the board, but those are always buys. These buys I'm showing you here, these are like freak buys. So these are like me saying like some stocks are at some silly prices and I got to put some big dog money into it. So Nike, bought 300 shares there. It was a little over a $20,000 buy. Next stock up here I bought here today is Elf Beauty. This, folks, is a big dog buy. I bought 667 shares of Elf at $62 and some change. It's a $42,000 buy. This buy with Elf today is me kind of calling a bottom here. Can we go down to $55 or something? Yeah, it's always possible. But the moral of the story is I don't feel like we have that much more downside in regards to Elf. And so that's why I do a big boy buy like this here today, right? And if I'm off a few dollars, like if Elf went to 55 or 57, so be it. The moral of the story is, in regards to Elf, I'm much more scared about not buying this at 62, and then it goes to 200 plus over the next 3 to 5 years. And I'm stuck here looking, and I'm like, why did I not do that big buy I was thinking about doing at 62? Just because I thought I might get it at 57 or 59 or 55. Like, who cares? Like, the moral of the story is, if I'm right on Elf, and this is going to become a $200 plus stock again, right? Like at 62, give me the money. Like, because then that $40,000, right, ends up becoming, we can call it $120,000, $130,000, $140,000 over the next few years. So, pretty good ROI opportunity there. Next buy I went ahead and made here today is AMD. 111 shares of AMD I bought here today. Paid $106 for that. About a $12,000 buy. Now, let me be real crystal clear about these stocks like AMD, like Nike, like Elf, like Estee Lauder. A lot of these stocks I've been buying heavy for the past, we can call it 3 to 6 months. I'm in the last inning of buying these stocks. This is the last inning. Meaning, I'm going to wrap up my buys on these stocks likely over the next few weeks. Okay? I've been adding these stocks aggressively. I've built great positions in all of them. Celsius fits that category, right? And I'm pretty much about wrapped up here. And so I'm already starting to look at many companies that is the next group of stocks I'm going to be buying. And so this is the way I do this game. I see a very attractive opportunity. I start investing into it. If we happen to go through a correction at that time, then the stock starts going down, and I get to build my position much more quickly than I might have otherwise, and much more substantial than I might have otherwise, right? Because let's say I had invested in AMD stock, and I was buying a lot of shares at 120. But then instead of it going down to 106 or to $100, let's say instead AMD went to 140, 160, 180. I'm just going to be honest with you guys. I would not have built this AMD position that big if it went to 180. However, I went to 100. Now I'm so much more incentivized to buy more shares and more shares and more shares, right? So the moral of the story is I bought a lot of Nike shares now, a lot of AMD, a lot of Celsius, a lot of Elf here recently, Estee Lauder, those sorts of stocks, this last group of stocks. And so I'm in the last inning of buying them. We're almost concluding. And then those stocks will just be a hold for the next few years. And, if everything plays out the way I think they're going to play out in these stocks, I'm going to make a lot of money. And there we go again, right? And the next batch of big winners come through. So, and it doesn't always mean every single stock's going to go up that I invest in, right? Sometimes I'm wrong. Sometimes there'll be ones that just don't work out. And I was like, dang, man, I missed it there. And that's fine. And, for any of you newbies in the market, you got to understand that's the cost of doing business. The cost of doing business is sometimes you're going to be wrong. And you have to be okay with that. You have to be okay with failing sometimes. If you can't deal with, failing sometimes, you can't deal with the big house. You can't deal with the big, the nice cars. You can't deal with the nice vacations. In order to get to all that stuff, you got to fail. I don't know anybody that ever got wealthy in this life and didn't have a lot of failure along the road, where they messed up, they did things wrong, they made bad investments, they made bad businesses. I don't know one person, and I know a lot of wealthy people nowadays, including myself. I've made plenty of mistakes, I got plenty of stocks wrong, but the moral of the story was over the past 16 years, we got a whole lot more right? And that's all that matters. And that allows you to then go on and prosper, right? And reach levels that you never thought was possible, reach financial goals that you never thought was possible, or, let's call it achieve whatever you did think was possible and achieve your dreams. But you have to get over this fear of being wrong. This happens. And somebody who thinks it's oh, I'm going to get under Jeremy's skin because he was wrong in that one I don't care. It's the cost of doing business. And I'm going to be wrong about other stocks, right? There might be a stock in this latest batch I was buying that maybe it doesn't work out. I look back, I'm like, dang, man, got that one wrong. That's fine. In the next batch of stocks I bought, hopefully they all work out, but there might be one or two that don't work out. And that's fine. It's the cost of doing business with being an individual stock investor. The math works. As long as you're a lot more right than wrong, and on your big investments, you're right. Oh my gosh. And then when you take risk in, let's say, some riskier stocks, right, you got to keep allocation smaller. Because let's think about it. If you got some company that you're investing into and it's this company's either doomed for bankruptcy or it's going to be a 10x type opportunity, right? If you keep position sizing small, well, if things don't work out there and it goes to zero or something close to that, right? Well, you lose a smaller amount of money. However, if it's really that 10x opportunity you thought it was, and it turns out to be that, a very small amount of money becomes a very large amount of money very quickly. Palantir would be a great example of that, right? We're up 1,000% plus on Palantir stock. It has been a tremendous gainer for us, and we've been able to take ridiculous, hundreds of thousands of dollars of profits in that stock, right? Tesla, I think I took, Tesla's probably in the millions, right, of profits. And for Palantir and Tesla, those are good examples of I took smaller position sizing because I understood there was a lot of risk back in the day when I was investing in Tesla, as there was still a lot of risk in Palantir when I was investing in that very heavily in 2022. But I took a smaller amount of risk and it paid off ridiculously well compared to my portfolio size. I didn't risk the farm, and so I didn't lose the farm, right? And so that's another component you got to kind of keep in mind there, right? Just trying to give some game out there. Another buy I made here today, 150 shares of SoFi, $12.75. SoFi is a really good example of a stock that if you want to talk about a stock that has, 10x, 50x opportunity long term, SoFi is a great example of that. But it comes with risk. You don't see me risking the farm in SoFi, do you? No. But I'm adding the stock here and there, right? Did around a $2,000 buy here today in that one. I got a decent sized position. I got 3,700 shares in the public count, which is a very modest position considering the size of the public count. That's a portfolio that's close to $3 million. And so 3,700 shares of SoFi is not a large amount. So you don't see me risking the farm in SoFi because it comes with risk. At the end of the day, it's somewhat of a financial institution, right? Obviously, they got their fintech side of the business, but they do take loan risk on certain products. And you never know what happens if a big recession and people don't pay it back. What happens with SoFi? Would they have to sell to somebody in that sort of environment? Could they go under? Anthony Noto seems like a type of CEO that's not going to have that happen, but there's always that risk, right? Always that risk. And by the way, that's a risk in regards to almost all financial institutions. And so my view is if SoFi is that 10x, 50x opportunity, right, over the next 10, 15 years, oh my gosh, a small amount of money is going to become a ridiculously large amount of money. And at the same time, I'm not going to risk the farm in that stock in case I'm wrong and they fail along the road. And then I'm stuck in a situation where I'm like, oh my gosh, why did I put $1 million in SoFi? I'd much rather always look back, especially if it's a riskier stock that I'm buying at that particular time, right? That comes with a higher level of risk, right? I'd rather look back and say, why didn't I invest more? I wish I would have put even more in that stock, rather than I look back and I say, why did I put that much? That was so silly. That stock was way too risky. I took way too much risk. I'd just much rather be on the other side and say, I wish I put even more in it, right?